Thanks for sticking around to the last paper of the day. This is joint work with colleagues at Duke, Dan Garrett, Andrew Orden, and Jimmy Roberts. And in this paper, we want to think about auctions for municipal bonds, so competitive placements. And we want to think about how tax advantages for municipal bonds interact with certain features of the auction market, and how that affects the borrowing costs of state and local governments. Usually when I give this talk, I have to motivate why we should care about municipal bonds. Here, everybody knows about municipal bonds, so I'm not going to spend too much time, but we know it's a really large market. It's about $3.8 trillion. Interest payments alone are about $124 billion, and that's more than what we spend on many other things. And we also know that the municipal income from municipal interest is excluded by the federal and most states. Right, so we want to know, are these tax advantages that the federal and state governments giving owners of municipal bonds, are those actually affecting the borrowing costs of state and local governments? So that's the first question. And the second question is, we know that this is a tax expenditure that reduces the revenues of the federal and state government. So for the federal government alone, it's forecasted to be more than $500 billion over the next 10 years. So we want to know, is this actually something that's an efficient way of lowering borrowing costs? And one particular worry is that the group of people that benefits most from this exclusion of income is top income filers, right? So does it make sense for us to be excluding the income of top income filers for whatever reduction in borrowing that we're gonna see? What we're going to do in this paper is we're going to look particularly at auctions. Auctions are really nice because you have a lot of information. You have not just the transacted price, but you have all the bids of every underwriter that participated in the auction, and we can use that to get more information about how taxes are affecting these auctions. So we're going to use variation in state and federal taxes to see what's the effect of the change in tax to the borrowing costs of local governments. So the underwriters are going to be bidding true interest cost bids. And that's why the bids are going to be equal to the borrowing costs. And then what we're going to focus on is how these taxes are affecting the auction market. Usually when you have a very competitive market, you would imagine a one-for-one pass-through, where if like one minus tax is the advantage of the excluded bond, you would expect that to have a one-for-one pass-through on the borrowing costs of local governments. When you have imperfectly competitive auctions, you can have multiple effects going on. So you can have a direct effect of the subsidy, but also it might be the case that if people are bidding strategically because they know that they might actually win the auction if there's very few bidders, the change in the tax is going to affect how bidders are going to behave, and it also might affect the number of bidders that participate in the auction. So we're going to bring a basically game theoretic approach to thinking about these auctions and participation in these auctions to think about what are the effects of taxes on these auction outcomes. What we find overall is that the interaction between tax advantages and imperfect competition, so the fact that there's not that many bidders, is going to generate really large effects of taxes on borrowing costs of local government. So we're going to find greater than unity pass-through, where we usually should find one-for-one pass-through. Okay, so preview of the results. I'm going to give you some reduced form regressions that are just going to show that when you increase the tax advantage, the borrowing costs are going to go down. In particular, a 3 percentage point increase in the tax advantage is going to reduce borrowing costs by about 9 to 10%. So it's a pretty large effect. If you want to think about it in terms of elasticities, instead of being a one-for-one elasticity, we get something in the region of 1.7 to 1.8. Right? We're also going to show that one of the channels through which this works is that the tax advantages are leading to more competitive auctions. So we're going to have more auction participants whenever taxes are higher. The second thing we're going to do is estimate a structural model of auctions where bidders are going to decide whether or not to participate in the auction and how much to bid, knowing that there's different numbers of bidders. And here we're going to show that the effect of taxes on the strategic bidding and the strategic entry margin is what's going to be really driving these large pass-throughs. So we're going to estimate this model, and we're going to recover what the median markup is going to be in the data. And just to clarify, when I say markup, I don't mean, so I know people use the word markup for different things. I mean the word markup is the bid that I make when I win an auction relative to the lowest bid that I would have been able to do. So it's not relative to like a transacted price that already happened. And then we're going to show simulations that are going to show us that for every dollar reduction in the federal tax expenditure, there's going to be an increase in municipal borrowing costs of $2.8. So that means that it's actually, because of the effect of the interaction with imperfect competition, the tax advantage is actually going to be a cost-effective way to reduce the borrowing costs of state and local governments. And this is something that people in the literature haven't looked at because they haven't looked at the origination margin. Usually the literature focuses on the secondary market, which has very low liquidity, and you're not able to see those results. Okay, so that's kind of a bit of a long introduction. let me just go to the most important part. So let's start here. Okay, so we have a lot of data. We have 14,000 auctions in our data. These are municipalities that decide to have a competitive placement. We have data from Bond Buyer and from SDC Platinum, where we have a lot of details on the municipalities and the offerings. We also have a lot of data at the state level on the policies that are going to affect these bonds. So the main variable that we care about is this effective rate variable, which is going to combine federal and state taxes. The reason why these two interact is because of state and local tax deduction. And that's something that we're going to be able to simulate in our data as it gets capped. How does that affect the borrowing costs of state and local governments? And then also there's going to be variation which states are actually going to be excluding municipal bond income from taxation. Okay. So this is the first regression that we're going to run. The estimating equations at the top is just saying what's the effect on the winning bid of changing tau, which is going to be our effective rate that's driven both by federal and state variation. We're going to have state year fixed effects and as many controls as you can potentially imagine. What this means is that number 6.5 means that a 1 percentage point increase in the effective tax rate is going to reduce the borrowing cost of state and local governments by 6.5 basis points. Right? On the median borrowing rate is about 221 basis points. So that's, if you think about it, that elasticity, you can use those numbers to get that 1.75 elasticity that I alluded to at the beginning. There's a lot of tables in the paper where I go through all kinds of potential controls that deal with market uncertainty, that deal with interest in environment. Here, for example, we have the political party that controls both. We have the Senate, the state Senate, the state House, and the executive. We have controls for all of that. We have personal income tax controls, sales controls, business and property tax controls. Really, what's driving the variation here is changes within a given municipality in the taxes that they have to face, right? So think about a school district that issues 2 bonds across periods where either the federal or the state governments have changed taxes, right? So a way to view this is to run this regression in changes. So here's a visual representation of that regression in changes, where it's really just the same municipality issuing over time. And this is just saying, if you go to the right, if you increase the tax rate, then you're going to have lower borrowing costs, right? Now, a placebo check that you can do with is say, well, what happens if you think about the effect of future taxes that haven't happened yet? Does that have the same effect? And the answer is no. This is kind of a, reassuring, because it tells you that what's really going on is the effect of the tax and not something else that's going on, like a trend that's going on at the state level. We can also see this in a dynamic way. And see, the black line, vertical line, is when there's a lot of vertical lines here because of the screens. But this line is where there's a change in the tax rate. You can see that before there's basically no effect. And then when there's a change in the tax rate, there's a decrease in the borrowing rates. And that green line is that 6.5 borrowing rate. Okay, so we do a lot of checks in the paper to try to convince you that that's an effect that's trustworthy. And I'm happy to talk about all the things that we do. But overall, we're finding a pretty large effect. So 3 percentage point increase in the tax effective rate, reducing borrowing costs by 9 to 10%. That's about a 12% billion savings per year across state and local governments. So that's a big effect. And again, this elasticity that's greater than 1, I see Kim shaking her head or, being a little bit confused about how to think about this. So what we do in the paper then is try to think about, why is it that we're finding these large effects when the literature hasn't found these large effects, right? So one of the things that we find is we run the same set of regressions, but now on the number of bidders, right? And so here what we find is when the effective rate has a positive coefficient, it's just saying that the higher the tax rate, you're going to have more bidders participating in the auction, right? So if you have an auction that only has 2 people, you're going to be like, well, I'm going to try to shade my bid so that if I win, I get surplus. But if you have 20 different bidders, you can't do that, right? Because you're going to lose. So this is one of those. This is where imperfect competition is interacting with the taxes, because as you increase the tax rate, you have more competitive auctions. Okay, so progress so far. I've shown you reduced effects on the bidding rate and the number of bidders. Just the fact that there's low competition in these markups should make us think that there's going to be markups. So on average, we have 5 bidders. Now, this reduced form analysis is limited in a number of ways. We can't really think about all these different forms of strategic bidding, entry margins. We want to try to unpack those margins. We also want to try to simulate the effects of different tax proposals, like, for example, components of the Tax Cuts and Jobs Act that either increase the top rate or got rid of the state and local tax deduction. So in order to do that, we're going to estimate a structural auction model. I'm not going to be able to do that in the 5 minutes that I have left in this presentation. I'm just going to give you some lessons that we learned from that exercise. So here, that exercise allows us to back out what is the markup on each one of those auctions. So on average, markups are about 16 basis points. The markup rate, so the markup relative to the actual winning bid is about 17%, and the markup value over the life of the bond is $173,000. So these are not really big numbers, but they're important. And the way that I think about these markups is, the underwriter is going to get the contract, and then they have to place it. So they have to do that work to actually put it out there, and that's what these markups are paying for. So it's not saying that it's completely like profits from heaven. It's just part of the job that they have to do to actually complete this transaction. Now, if we look at states and state authorities, the markups are much smaller because they have more transparent, more competitive auctions. If you look at schools, they have higher rates overall. Okay, so we can use this kind of model to think about why we have such large pass-through. And again, there's going to come from three different forces. So when you have higher taxes, that's going to have a direct effect on the bids of how much people value these bonds. Because now the tax excludability is going to be larger, right? Now, you're also going to have more entrants participating in the market, as we showed. And then also, their strategic considerations of how aggressively to bid might also change, right? So these are going to be the three channels. This is just kind of like math for people that are used to thinking about auction models. B is the bid, V is the value, and then basically you're trading off the likelihood that you win relative to how much you shade lowers that likelihood, and that's what determines that markup. That's a right term. And so what we're showing is that the effect on the winning bid is going to depend on how much your value changes and how much the markup changes. So here's an illustration of this. So starting from somebody that has a value of 1.6, that's like the true interest cost. You have 6 bidders, and you go from increasing the rate from 35 to 39. If this person just participated in the auction without any changes, they would bid 1.9 in interest rate. If you just change your own value, that would lower the value to 1.5, and it would also lower the bid just a little bit, right? That would give you a pass-through of about 0.5. Now, if everyone else changes their value, then you know that people are going to bid more aggressively, so you have to further lower your bid to 1.7, and now the actual bid is going to change to 1.5, 1.1. Now, if you add more people to the auction, you further know that it's harder for you to win, so you have to lower it further. And this gives us that increase in the rate of about 1.75. Now, what's interesting here is I have the change in the markup, right? So that information rent that the winner was getting in equilibrium, this elasticity is really big. So what this is saying is, as you increase taxes, you make the markets more competitive, and that really reduces the markup in equilibrium. And that's why we're getting really large pass-throughs. We can show this in the data just because we have the whole probability that you can win. That's actually going to decrease the likelihood. I'm looking at this number going really fast, so I'm trying to figure out what to focus on. So just to give you a sense, this is the likelihood that you win for any given bid, right? And this is just data. I haven't done anything to this. I've just plotted it. And so this is saying, on the green line, I have a tax of 35%. If I increase the tax from 35 to 39, that decreases the likelihood that I win at any given bid. But it also makes this line steeper. That means that you're not able to really get a lot of markup in equilibrium. And that's a force in the data that's telling us that the markups are being affected, and that's why we have such large pass-throughs. Okay, so the last thing I want to do is show you some simulations from our form model. Here we start from average data where the winning bid is like 1.9. If we go to the reduction in the top tax rate from the Trump proposal, that's in the Tax of the Job Act, that would increase the borrowing rate by to 2. The Obama proposal was to limit the excludability at 28%, and that would actually move even further to 2.5. You can also just completely get rid of the exclusion, and that would move it even further. Now, you can also do the exercise of getting rid of SALT. SALT actually increases the value of the tax excludability, right? Because now basically the effective state tax rate went up. And so this would actually decrease the borrowing rate from 1.9 to 1.7. Right? When you do the combination of having lowered the top rate in the Tax Cuts and Jobs Act plus having capped SALT, that actually lowers the borrowing rate from 1.9 to 1.86. Right? If you want to see it in percentage, it's down here. Just the rate would have increased the borrowing rate by 4%. Getting rid of SALT would have lowered it by 6%. The combination is going to lower the borrowing rates by 2.5%. What's interesting about this is that the effect is coming through the effective markups. Right? So this number of negative 10% is telling us the source of this. All right, so let's just get to the last question, which is this an efficient way to lower borrowing rates? So let's consider the Obama policy of going to 28%. This actually reduces borrowing rates by about 30%. Right? Okay, so on average, borrowing costs are gonna increase by 30%. This is gonna imply $38 billion in interest payments by state and local governments. So that's an additional payment. If you think about the yearly federal expenditures, that's about $13.5 billion. And that's where we're getting that for every dollar of a reduction in federal expenditure, so the 13.5, is going to cost you 38, so that's going to be about $2.8 per person. Okay, so as we know, this is a huge tax expenditure subsidy. It's bigger than many other things we spend money on. It concentrates on top income filers, so we want to think about, is this a way to actually lower borrowing rates? And what we find is that because it's encouraging competition and making the market more effective, it's actually reducing borrowing rates. And I'm going to stop there.
Great, thank you. Sorry. we had a bus, so we were running a little behind.
That's right. I'm going to go fast.
Yeah, go fast, and then we'll just have a few minutes for questions, and we'll finish.
Okay.
Thank you. Yeah, it was very good.
So I'm not even going to do slides, guys. So first of all, if you thought that was hard to follow in 25 seconds, you should see the paper, which is equally difficult. Actually, there's a lot here, which it's unfortunate that we're going to rush through this because for those of us that are participants in the muni market on the side that I'm on, which is actually on the firm side, and the day-to-day side, this actually has a lot of interesting thought in terms of what we're doing with respect to tax policy. Those of us that are in the broker-dealer community know that we've been arguing forever that we don't want to tinker around with the deductibility and the federal exemption. We just want to leave it. We like it. It's working. GFOA likes it. They were supportive of trying to keep it in place, not tinkering with it. We've shown for decades now that this has a public benefit. And hopefully, with some of the information that's in this study, we'll be able to continue that dialogue a little bit. What I will say is the imperfect competition part is a little bit tricky. Right now, competitive bidding is about 30% of the overall new issue market. So it's not even a majority of the new issue market. And it's highly dependent upon whatever is happening in the market at the time that the market is engaged in the bid process. So if we are in a period of time where there's not a lot of supply, bids are going to be unnaturally tight. And we've seen that over the last probably 6 months as supply is really tightened. The bids have gotten abnormally tight. The other piece that comes in, which goes to the lowering of your borrowing costs, not only is that tightness of the spread, but what's been happening is a lot of refunding activity because as rates have gone down, municipalities have taken that opportunity to refund. Those refunded transactions on a competitive bid deal are not priced anywhere near a negotiated deal because those transactions are actually priced so that the underwriter knows that they can flip them overboard as soon as they own them. So you see a lot of discount bonds, you see a lot of bonds in that 3%, 3.5% category. There was a period of time in sort of the January, February where we were down at 2.5% on coupons. Very unnatural for somebody that's a larger state issuer that's used to seeing 5% coupons on their new issue bonds, especially when they do them on the negotiated market. So I do think there's some pieces here to be thought about, though we all know there is efficiency in the competitive market. There is efficiency in the pricing in the competitive market that does not exist in the negotiated market, but it really is situational compared to what we're doing with coupon structure and the supply of bonds in the market as it stands. The other piece to your research that I was going to suggest that you do with respect to lack of participants is one of the other problems that's faced this business line is that we are shedding firms left and right. So there are fewer and fewer firms that are able to participate, especially in traditional competitive behavior. So what they're doing is they're joining up with other firms. So you may have one firm going in on a competitive firm that actually is a syndicate of 20 firms. So that somewhat masks the participation levels that are happening. The other piece that's important is the capital availability of the firms. Not every firm has the capital to hop in. So even though it would be awesome to have that kind of structure where we could all say, yay, we want to go do this, there are some capital restrictions with respect to what we could go in and bid. The other is a risk reward. Even really up until probably 2 years ago, there was a pretty significant risk reward for competitive bidding. You knew if you bid, you probably had enough upside not only to get your bonds put back out into the market and get them redistributed, but also to have some small profit to take hold for situations where you may have market change. We do not have that anymore, so what you're starting to see is a little bit of a pushback on some of the competitive bids with respect to the pricing. So it'd be interesting to see sort of the difference between a 2016, 2017 versus a 2017, 2018 type structure. Again, the other piece to the puzzle that did happen with the new tax reform is bank participation, which was a significant driver in the competitive market for a long time. They were a good buyer. With their corporate tax rate having changed, they have exited that market, which is the other reason there's going to be a little bit of a difference, I think, in some of the data you're going to see from January 1 going forward, because they were a pretty significant part of that. Okay, I'm going to stop so we can do a couple minutes for questions.
Okay, questions? I'm gonna ask you, yeah.
So I'm not even sure I'm asking a good question or not, but what are there any implications of this for if you had tax credit bonds instead of tax exemption and the broadening of the markets for, with the tax credit bond?
We didn't look at anything like that. I guess the biggest point I think we can make with this paper is usually we think of this tax as not this tax advantage as not being a really great idea. Here, the reason why we're finding it's a great idea is because there's low competition, and there's low competition for many different reasons. And you can also just increase competition in many other ways. You can have a state that says, I'm going to just issue bonds for my state, and then I'm going to lend money to my municipalities. You can do that in a way that in that case the tax advantage would no longer have such a large effect. I just want to respond really quickly. Thank you for all your comments. I completely agree with basically everything that you said, and I would just say basically, and I think it's important to try to think about how you're thinking about it and how I'm thinking about it.
Right.
I think a lot of things that you said are compatible with our results.
Absolutely.
It's more of just kind of like saying, I've been looking at over the whole last 6 years overall. On average, the pattern holds. In the last 6 months, a lot of things have changed, like tax reform, and the way that you were thinking, for example, about actually having a risk reward so that it's worth to be in this business. That's what I think markups are.
Right.
Markups are, is it actually worth it to be in this business? And what this is saying is when there's more tax advantages, it's tighter,
Right.
and that's I think the way that I would try to reconcile our thoughts.
Right. And one of the other pieces that's in the study, that was in the study that we didn't have a chance to talk about was actually retail participation. The problem with some tax advantaged bonds, or what we would consider sort of special programming like BABs, things like that, is that they tend to dissuade retail buyers from coming back into the market. So when you look at whether or not we've actually got some efficiency in the market with competitive transactions or with this concept that a higher tax rate, leaving the tax rate where it's at for the top earners, that tax exemption makes sense. That's a lot of where that play is really in allowing retail to come in and out. So the interesting variable for this is going to be to look at the bank participation, because that was the one true market participant who's really started to pull out, simply because there's no incentive for them under the BQ rules to be able to really generate what they were looking for before.
I guess I would just say that you would probably find even larger effects than we're finding.
Yes.
If the markets are getting even less competitive because banks are exiting the market.
Yeah, Kim, so it's for coming. It's just gonna go.
So this is all fascinating, and it makes my brain hurt a little bit, and I want to sort of dig into it. I'm wondering, can you talk a little bit more about the across time versus across state parts of this? Like, I'm sitting here trying to figure out what part I think California and New York play in this and how that changes with the limit on salt, right? Because they have higher taxes overall because of the federal tax rate plus the state tax rate, and there are more people at that top marginal tax rate in those states. But there are also bigger markets that I wonder if they're more competitive in the first place. Like, so I'm just trying to figure out how much of this is a state effect versus what's going on with the competition and how much that interacts. And I don't even know how to get my head around what the salt limit does to that.
So, a couple of responses to that. So one of them is, of course, the regressions are averages. We do have this feature where we can do that in changes, so it's really identifications within the state. And in fact, it's within the municipality. We can have municipality and buyer and bidder fixed effects. So that's going to absorb a lot of the variation. But so I think in terms of like what's giving us that large pass-through, I think that's one of the things. In the structural model, one of the things we can do is we can say we can condition all of this on the number of bidders and on the size of the state. And so we can have state fixed effects that can tell you in California this is going to be different than in New York, and we actually do everything state by state, and we have everything on maps. So you can look at the map and say like actually this state is the one that's having a larger effect because it started already being not very competitive. And so we have maps in the paper where we have competitiveness by state, and then also the effects on markups and on the borrowing cost by state. And so that's the way to think about it.
Bob Tarenko, University of Illinois, Chicago. The question's mostly to the discussant. Make the point about the difference between competitive versus negotiated. And I was wondering does it really matter? And I need some institutional detail. So if I'm issuing and I'm making a decision to go competitive or to go negotiated, is at the end of the day, are they more or less going to give me the same yield, or are there going to be other factors that matter? Because I can think of a competitive world where competitive versus negotiated is going to kind of yield me the same thing. Perhaps that's not true, and you may have a lot of institutional answers to that query.
The long view on that is, let's say you're a very large issuer, so you're a state level issuer, you're a major city issuer. So you're issuing $1 billion of DASNY bonds. There's not very many underwriters on the face of the planet that are going to be able to handle a competitive bid for $1 billion worth of DASNY bonds. Now, competitive bids at $1 billion happen, but they take weeks to sort of push through the market. So they'll buy the bonds, there's some period of time that they're holding it, and then they'll start moving it back out into the marketplace to get it. The danger is that secondary markup. So it's not just a primary issuance market problem now, but it now suddenly becomes what does this look like in the secondary? Because now the bid from day 1 to day 30 looks very different, or could look very different depending upon any number of a million factors. Some states have rules about doing, and this is the other thing, there's a patchwork all over the US of what is a required competitive deal situation, what's a required negotiated. Some states, the first 500 million of all their bonds have to be competitive, et cetera, et cetera. So this process isn't perfect, but that's one of the things with the paper that needs a little bit more development is that whole competitive negotiated aspect.
Yeah. So in the data that we have, about half of the volume of the sales is in competitive versus negotiated. There's definitely some selection that you can see into what's competitive, into what's negotiated. We've tried to include everything together, and because we want to use the institution of the auctions to really think about imperfect competition. That's how we focused on that. But I think it goes back to Dan's paper at the beginning on thinking about the relationships. If you look at who is the bank that actually is the underwriter when they're negotiated placements, there's a lot of stickiness on who's the advisor and who's the underwriter. And I think thinking about from the finance point of view, thinking about the relationship and how that's affecting borrowing rates, I think is a big deal.
All right, unfortunately, we have no more time, but thank you. Help join me in thanking our panelists.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.